Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Joining me today, well, it's the professor, Professor James Eng. James, how are you?
Good. Thanks for having me, Paul.
We call him the professor because he is the smartest guy in the classroom. He teaches, he does all kinds of knowledge about apartment financing, all kinds of knowledge about triple nets and construction deals. If he wasn't doing apartment loans, he would be teaching, senior in college, high-level mathematics and real estate finance. And so you couldn't have a better guy in James Eng to kind of explain what's going on today. So James, thanks for being in the podcast. Let's go straight forward. We talk about this is a team sport, and at Old Capital, we hopefully are your lender to kind of give you advice about what's going on. But one of the things that I want to talk about before we start talking about being a team sport and what's going on today is let's talk a little bit about that Old Capital conference that James and Christine Eng with Old Capital put on last week or so. Boy, we had 600 plus people there. James, talk to us a little bit about the event itself.
Yeah, the first night we had probably about, 60, 70% of the people over at a happy hour. And it seems like this thing keeps growing every year. And I think, coming out of COVID, people were probably in a little shock about how many people were there and how close everybody was to each other. So it was definitely a good time. So we had a happy hour the night before just for people to mix and mingle. And really it's a chance for Paul and I to walk around and say hi to everybody before the big show on Thursday. So Wednesday night we had our happy hour. And then on Thursday we had a full show. So full day of 500, 600 of our closest friends coming out and giving us really the lay of the land. And we started off with JP Conklin, and JP was really getting into the nuts and bolts of interest rate caps, getting into what the Fed is going to do going forward and sort of the drivers behind that. No one can really predict what's going to happen, but at least understanding where it's going and at least preparing yourself for how the Fed's looking at inflation, how they're looking at federal funds rate, and making sure that you can explain that to your investors. So he probably had about 20 slides that he went through. And then we really got into listing brokers and lenders in the morning. And this was probably the most humble listing broker panel out there that we've seen in the last 5 years in terms of what people are seeing from the listing broker side and these sellers coming off of prices a little bit from the peak. And I think that's what everyone's trying to figure out is how much are these deals worth in today's market and what buyers willing to step up and buy these deals. And the first question usually is, all right, I can buy this deal for $20 million, but what does my debt look like? And so that's really what you came in and talked. We brought in Fannie, Freddie, bridge lenders, people from across the spectrum on the debt side to really talk about that on the lending side. And then in the afternoon, we talked about GPs and then also how they were raising money. I think the panel we had up there probably raised about $100 million in the last 60 days. So they're out there doing it and talking about how it's really not just the deal or the person, but it's everything in between, right? Getting to know these guys beforehand, seeing their track record, taking them on property tours, taking them to lunch, doing all this stuff before the deal is even launched. And that is a 24/7 job before you even have your webinar. You got to have that stuff in place. And then we wrapped up with the asset management panel, which I thought the next couple of years, you are not going to make money on cap rate compression anymore. So you're going to have to actually drive the NOI up on these deals. And so that's what we sort of wrapped our panels up with in terms of property and asset management. So had some of the best property managers here in DFW talk, and then also talked about some of the asset management stuff that they're seeing on these deals. And by the afternoon, that was a lot of educational information. And we brought in Paul Mercurio to sort of wrap us up. And was a pretty big venue. It wasn't as big as Globe Life or Cowboy Stadium, but still pretty big venue. And our comedian is used to performing in dark basements. And so he definitely had his work cut out for him. But I think anybody who was there had a great time with Paul Mercurio. And he really just sort of interviewed some of the people in the audience, got a feel for what they did day in and day out. And then also sort of gave us some insight into what he goes through, sort of transitioning from attorney, Wall Street banker to a comedian. And so I think a lot of people who listen to this podcast, real estate typically is not their first career. And so giving us some insight into that while at the same time laughing out loud for 45 minutes. So it was definitely
he
a good
was
time.
pretty damn funny. No doubt about that. It is, as James said, Paul Mercurio out of New York flew in to see us. He was a Wall Street banker, and his firm did a lot of business out there with mergers and acquisitions, worked for Credit Suisse, and then started to have jokes to sell to Jay Leno, who encouraged him to get into the business, leave behind being a Wall Street attorney and come on into the comedy world. Now he writes and does segments on Stephen Colbert. And so he was a funny guy and definitely broke the mood about what's going on in the multifamily space.
Right. And I mean, he hung out during happy hour and just sort of walked around talking with people. I was just standing next to him and laughing the whole time for 2 hours. So, I mean, definitely a funny guy. And we went out for some steaks and took him to get some real steak here in Texas instead of the stuff up in New York. So it was a good time.
Yeah. And so again, thanks, James. Did a great job. Again, we'll have this event again next year. Again, give people just an eyeball of knowledge about, again, who comes to these things? So, what do you have to bring with you? Tell me who the average person that comes to the Old Capital Conference.
Yeah, my favorite line that we like to use promoting this thing is pretty much the DFW multifamily world stops for one day. And because everybody's at this conference doing business. So you're not going to get an email from any of these folks, but it's really everyone you need in the industry, whether it's listing brokers, lenders, property managers. And I would say the difference, like there's a couple of conferences this week here in Dallas. The biggest difference is that the guys who are putting this conference on, we actually know what the hell's going on in the industry and we're in it day in and day out. Whereas a lot of these other conferences, it's pretty high level. They might be talking about Class A amenities and things like that or development, but we're really more in the heart of buying in-place deals, B and C stuff, maybe some A- stuff. And so it's GPs. I think that's the biggest piece is that a majority of these guys, they're not the acquisitions guy for a big institutional capital group out of New York. It's typically guys putting together their own deals, syndicating the deal, putting their own money in the deal, raising money from family and friends. Those are majority of the people who are at this conference.
Yeah, again, 600 plus people were at this. And again, another great event for you to be at. So look for the Old Capital Conference, possible invitation coming out here in the next couple months for the 2023 event that we would want you to come. All right. Lots of smiles there. James and I were at the National Multifamily Conference back in January down in Orlando. And at that period of time, nobody was singing the blues at all. Everybody wanted you to know that they were out to buy more multifamily properties and they had more money than they knew what to do with. And they were going to bid these deals up and they were going to take these deals down and interest rates were going to be flat for the rest of the year at the low rates. And so we leave from there. We come back in February going into March. We see interest rates are starting to rise. Those big smiles started to become open mouth gaps of what's going on. And then all of a sudden, going into April, going into May to June, we have a kind of displacement of where values are at. Nobody really knows whether it's the buyer or the seller, what this property is worth these days. Today, we're seeing just like bringing together the general partners with the limited partners. Everybody right now that we're talking to is all looking for money to try to fund their deals. And so today I just want to get a kind of a sense of the market through James and give you kind of some of the things that we're seeing right now in the marketplace to kind of let you know what's going in out there. So let's start off with maybe question number one. Is this retrade 2.0 these days, James? Because we already had that retrade 1.0 just a couple months ago.
Yeah, I mean, when 10-year Treasury hit like about 3.5 in June, that pretty much triggered every lender to cut their loan on these bridge loans. And So a lot of deals got retraded. Some of those deals fell out, some of them came back. But what we're seeing now is with the 10-year treasury going up 3.8, 3.9, that pretty much has pushed out. Bridge loans are very difficult to get done. And, the bridge loan rates are SOFR plus, let's say 400 to 450. So your all-in rate to start might be 7 to 8%. And then a lot of people over the summer, they were using Fannie and Freddie debt. And that allowed you to buy deals at 5%, around that on all-in rate. But now the market's moved and it's probably up 100 basis points from August. And so you're probably up to closer to 5.5 to 6% on Fannie and Freddie right now. And so you have to buy on Fannie and Freddie, look at in-place cash flows, and they need a 125 cover on your debt service. And so people are pretty much underwriting 5.5 to 6% interest rates. And that works when you buy at a 6% cap, but it doesn't work at a 4% cap. And so cap rates really moved from 4 to 5, I would say, when the bridge loans got sucked out of the market. And now they're moving up from 5 to potentially 6 if the 10-year treasury stays this high. And so the gap between somebody was selling a deal at a 4% cap to selling it at a 10% cap, at a 6% cap in 6 months is 25, 30%. I mean, it's a huge number. And so a lot of these sellers are just sitting out right now. And so where, you came back from NMHC, it was January, February last year, there's 40 deals on the market here in Dallas, Fort Worth. And it was probably one of the most liquid markets in the entire country. And right now, I mean, there's probably 5 deals on the market right now listed. And most listing brokers are not taking deals out, because if they take it out and do 20 tours, they better be sure that seller is going to sell that deal. They're not going to do 30 tours, even though it is a little cooler. It's not 100 degrees right now. But they're not going to do all that. And then for you to come back and say, well, I wanted you to sell this deal on a 4 cap. There's no 4 cap buyers right now. The buyers are at 5, 5.5, 6% right now. And the reason is the debt's at 5.5 to 6. And so the days of the seller getting half the upside, I think those days are gone for now.
Oh, thank you, Mr. Good News. Thank you, Mr. Good News. So, I mean, what are you seeing in terms of raising equity? I mean, we talk about being deal specific, but general partners, you should do 1 or 2 things very well. One, find more deals, and the other one is raise more equity.
Yeah. On the equity side, I mean, there's people who definitely have good track records. They're underwriting their deals with lower leverage. They're raising a huge amount of equity right now. So before, let's say in 12 months ago, you only had to raise 20, maybe 25% of the equity. Right now, you're having to raise 40%, 45% of the equity into these deals. And so limited partners, they have a lot of capital that was returned to them in the last 12 months. And so a lot of those people are putting money back into these deals. I would say the harder deals to raise equity for right now are probably deals that have either a large floating rate component, or some limited partners just think that the general partner is still overpaying. Like the general partner might have gotten a discount, maybe 5, 10%, but then they might need a 20% discount. And so I think it is very difficult to pin down the value right now, because the cap rates are moving so quickly in the wrong direction. And so 12 months ago, you went under contract. By the time you closed, you were up 10%, like magic. But right now, you go under contract, you might be down 10%, which is not good. So, people are having to be a little bit more conservative right now on their underwriting and build in higher interest rates, build in a little bit more cushion on that residual cap rate. Because if cap rates are moving right now, then if it moves 25 to 50 basis points and all your underwriting is 50 basis points total, that's not enough room.
Okay. Finding new equity. I mean, I can't tell you the number of calls I've gotten this week. And again, I never get calls, but just from individual general partner investors say, listen, hey, Paul, how about putting some money in this deal over here in this place? And I'm like, yeah, okay. I mean, let's talk about that. I mean, what are you seeing right now? I mean, I've seen a little bit of desperation, I guess, in some of these general partners trying to get the money out. I can tell we've had a couple of folks that have had these huge 1031 exchanges, and so they get a little boost for when they sold a deal. That equity sometimes goes into their next deal, so they don't have to raise all that money. But James, is there a new bag of brand new limited partners coming that's going to be available for some of these general partners?
I don't know if it's I think the difference is that 12 months ago, money was free. And so when money is free, your savings account was zero. When you saw 4% cash on cash, you were all over that thing. But now, if the federal funds rate is 4%, your savings account's 4%, and then your cash on cash is 3%, that math does not work. You're not getting paid a premium to be in this deal, right? We all love real estate, but real estate is illiquid. So it's very difficult sometimes to get your money out when you need the money. And so if I'm getting 4% or 3% in my savings account, I understand it. You don't have depreciation against it. You don't have potential for upside on the deal, but you have liquidity. And so I think your competition, a lot of LPs before, you had no competition. If you were giving 4%, that was 4 times what you got in your savings account. But right now, if your savings account is 3% or 4%, whatever federal funds ends up being this year, and your cash on cash is still in the 4s or 5s, it's very difficult to extract that money from people's savings accounts. So they're going to have some reason to do it. And back in 2015, when I started, I remember looking at deals and it was like, you got 1 year of IO and most deals got double-digit cash on cash. And if you buy at a 6 or 7 cap rate and you have positive leverage, you can get back to 8, 9, 10% cash on cash. And if the federal funds is sticking around 4% or 5% for the next 12 to 24 months, that's what will get people off the sidelines. They will jump back in on these deals. And so that's what we're seeing on deals that are on the market where the seller has to sell right now, is buyers are sort of tiptoeing around saying, all right, maybe at 5, maybe 5.25, maybe 5.5 cap rate, I'm okay. Because at some point the rate will come down, but there's no competition right now on these deals. So instead of 20 offers on these deals, there's 3, right? And so if there's 3 offers and I'm the most qualified, most buyers are just putting in an offer and saying, all right, call me when this guy's ready at this price, because there's nobody else. I mean, it's just a whole different attitude right now.
I mean, James, are you seeing the institutional buyers buy these properties? I mean, on the A class, the brand new stuff coming out of the ground, who's buying some of this stuff?
I don't see many deals that are just brand new Class A stuff that's on the market, but I don't see, I mean, some syndicators stepped up and bought those deals at 80, 90, $100 million, but I don't think any of those guys have anywhere the amount of equity available right now to buy those deals. You know, on the institutional side, the only quote that I've heard on institutional is, don't send it to me unless it's a 5 cap. So that expensive too. Like, their debt is cheaper, but it's not that much cheaper.
Yeah, I mean, they're not getting rates of 3 or 3.5 or 4%. They're getting everyone else's rates, maybe just a little bit better, but not by very much. So they're at 5.5, 5.25 or so, you know, somewhere, 5.5 to almost the 6 what they're looking for. So they're not in the market right now. And, I don't blame them. In the B and C type of stuff, maybe there's a lot more players in the B stuff than there is the C stuff, the kind of the workforce housing stuff. So, in fact, the workforce housing is rehab number 17 on these properties that have been rehabbed. And now they're 40 years old, 50 years old, or 60 years old, and they're looking for possibly one more rehab. And so it's a little bit like looking for an extra chair when the music stops or so with some of these folks. The music has stopped a little bit. There's still some activity on those properties, but what a great time to get into it and kind of set your own destiny if you can raise capital. And what do you think about, what the question I get every once in a while is this private equity? I mean, who's doing private equity? How does that look? And, versus common equity, I can only, I need to raise $20 million, but I can only raise maybe 15 through common equity, and I got to raise another $5 or $7 million through private equity. What does that look like these days, James?
Yeah, I mean, I think one way to think about it is think about it as a stack. And a lot of people talk about the capital stack. And really on the bottom of that stack is your first mortgage, right? So whether it's Fannie, Freddie, maybe it's a bridge loan, maybe it's a bank loan. And then on top of that, typically six your common equity. And if you all have common equity, everyone's the same, then when there's cash flow, everyone's splitting that equally. The preferred equity or private equity, they're going to sit right on top of that first mortgage. And there's a lot of different ways of doing it. But a lot of times there's a hard pay of, let's say, 8%. And then another 8% or 7% needs to be paid when you sell the property or refinance the property. So they have sort of a fixed rate that they're trying to get to, whether it's 15%, 16%, something like that. And they're going to get paid before your LP equity gets paid. And so a lot of these guys can write check anywhere from $2 million to $20 million. And so we saw a lot of people maybe go up to 80, 85% of the capital stack. So they got a loan of 60, 65% from Fannie and Freddie, and then they got additional 20% from these private equity guys, and then another 10 to 15% of your common equity. The problem is the common equity is behind that preferred equity. So the preferred equity guy is going to get paid first out of the cash flow, and then they're going to get paid at the end of the sale as long as there is money to be paid. So even though as an LP, you might have a preferred return, it's preferred after that guy.
So yeah, it is an option with people that may have done 2, 3, 4, 10 deals. It's not your first deal. It's not your second deal or third deal. It's probably the fourth or fifth deal that you can show that you have purchased and sold major partners' money. That's who a private equity is looking for. But again, their money is not, it's one call to them, but their money is not exactly cheap at all. It may be 7, 8% current pay, and then you're going to accrue up to 12, 13, 14% on the difference. And just like James was saying, is that now on year 3, then that when that all that money is coming due for that deferred amount that's being accrued, is that money is you need to pay that. So not only do you have to pay the senior lender, you got to pay these guys off to get out of the deal. And so just make sure when you're going into the transaction that you understand where these properties may go up in value. Hopefully they do go up, but it's really not the value that I'm looking at. I'm really looking at the NOI to be able to pay off the senior lender, whoever is Fannie Mae or Freddie Mac as an example, and then also that private equity guy that maybe has $10 million. So we're looking at those two loans together to try to pay those guys off and bring that 12 or 13, 14% rate on that private equity down to 5, 5.5, hopefully at that period of time. So make sure you know your math before you get into private equity, and make sure you talk with your lender and make sure that's acceptable to do that with your structure, because not all lenders are going to allow that to happen. So work with guys like James and the guys at the team at Old Capital and ask them questions about what can be done and what can't be done. And then there's also rules of how big they'll go. And so, if it's $1 million or $2 million, that may not be worth that for them to do it. But if it's 5, 6, 7, 10, $15 million, and you'll get their attention, because that's a big chunk of change that they want to put out into the market itself. Anything more to add to that, James?
No, I mean, I think I always try to pick a graphic for the month, and the graphic this month was an iceberg, and the iceberg being on the top, everything looks good in terms of lease trade outs, high occupancy, strong demand fundamentals. But underneath the surface we're starting to see some of the cracks, and, it's stemming from a couple things. One is obviously the floating rate stuff that we've talked about in terms of higher debt service payments. If you didn't have an interest rate cap, that's coming very quickly onto you. And then these rate cap escrows, the cost of these interest rate caps it's probably 10x what it was 12 months ago. And then just having enough time to ride some of this stuff out. So if you're on a bridge loan and you have 3 years, it goes quick. And so, finding how to get out of some of these bridge loans with rising cap rates is, challenging. And then we're seeing people just come up with, I thought I raised enough money, but now I need an extra 5 million. And you're like, wait a second, you guys just closed 6 months ago or 12 months ago. So those capital calls are coming. So I think that's going full cycle back to the equity. When you're an LP and I don't know, 5 deals and you get a capital call on a couple of deals, you just don't want to keep feeding some of these deals. And so I think that's making some LPs become a little bit more sour.
What's your general observation? I mean, people, I think, are feeling a little bit more poor by the stock market being down 25 or 30%. Should they can take that strategy because they have their 401ks and their IRAs into stocks, and a lot of them are still in the market, which is fine. I mean, I'm in the market too, so I get it. But I'm also a real estate investor too. So, I mean, we're buying hard assets over a period of time. And I think it's proven itself out that, these deals are going to work, but it may take some additional time for it to happen. What's your take on that, James? I mean, are you still bullish, bearish, putting money back into the market?
Yeah, I think what's making people hesitate right now is the cash flow. And so, I think people can believe the value add story when values are going up. But when you're saying, well, we're buying this deal because it's going to go up, but the last 6 months values have gone down, right? So why am I still in this market? The only reason that I'm still in this market is cash flow. And so if you can step into a deal or structure the deal correctly, where either your debt is fixed or you're doing a floating rate, but you're buying a cap that's pretty tight, and the deal still works, it still cash flows day one. And maybe it's not the highest returning, right? So maybe instead of 15%, it's 11% or 12%, but then it cash flows day one or very soon after day one without, raising rents 30%. Then I think a lot more people are going to be comfortable with that deal because they can still get 4 or 5% cash on cash, or 6% or 7%. The higher, the better in terms of cash on cash. And I think that's what's going to drive people back into this market is all the stuff that you love about real estate. That's all great. But when you're getting paid less than your savings account, people don't love that. And if they see values going down, you don't really know when that's going to end. But if it's cash flowing, you're comfortable holding the asset. And if you have longer term debt, then you're comfortable waiting it out. So I think those couple things are what people need to see before they come back into this market.
Yeah, a lot of people ask us, well, why did I do an adjustable rate on this bridge loan? Wasn't there fixed rates available at that period of time? And is there fixed rates today? James,
Absolutely.
happened?
Yeah. I mean, I think you have to look at it as a combination. Let's say you buy a deal, you put a fixed rate loan on it. You typically have some sort of penalty, whether it's yield maintenance or defeasance. And that can be anywhere from 5, 10, 15, 20% of the loan amount. And so you have to sort of do the math and say, well, I've got a 4% interest rate and that's locked in. But then at the end of the term, I've got to pay 10% of the loan amount in fee in terms of yield maintenance, in terms of a penalty. And so some people who did a floating rate loan, they maybe are paying 5 or 6% right now, but then you have a 1% prepay. So the math works out in your favor. It's just, I think on a lot of these floating rate loans, the general partners hate it every day they have it, except the day they sell it. And the day they sell it, they love that 1% prepay. But the whole time through it, the one thing that maybe we didn't tell people enough is on these floating rate loans, you've got to buy interest rate caps and you got to have more working capital to make it through the floating rate volatility. And when you had a fixed rate, you knew exactly what your payment was going to be for the next 10 years. Whereas on these floating rate loans, you don't know what your payment's going to be. And then you also don't know what your interest rate cap escrow is going to be. And that is going to drive your cash flow crazy and not in a good way. So if we're above 3.5%, 4% on the SOFR for a while, it's everybody who has an adjustable rate mortgage is going to get a knock on the door from Fannie, Freddie, or their bridge lender saying, you need to buy another cap. And those caps are going to be 300,000. It could be right now, a 3-year cap is probably 4 to 5% of the loan amount. Whereas a year ago, it was, less than 1%. So that day is coming for everyone on adjustable rate right now.
Any final words before as we finish this up that people at this period of time should know, whether they're investors or they're general partners or they're applying for a loan? What's your words of wisdom to leave everybody by?
I think there's definitely going to be opportunity. Unfortunately, it's going to come at the expense of someone else's equity, I think, at this point. And so the past couple years, 5 years, 6 years, 7 years, cap rates have compressed. The market's gone up. Everybody who has sold, whether they moved NOI or didn't move NOI, they made money. Right now, the people who are going to have trouble on whether it's bridge or adjustable rate mortgages, they're going to have to do something. They're either going to have to do a capital call to refinance their loan, or they're going to have to sell the deal. And so we're starting to see deals that traded 9 months, 12 months ago, and they're already back on the market. And the reason they're on the market is there's no cash flow, and they're going to have to sell for a lower price than they purchased it for. And so once you start stepping into that market, I think if you underwrite the deal at these higher rates and the deal still works, it still cash flows, and you're able to get it at a lower basis, sort of is going to reset the market. And so as a buyer, I think you have to be close to these deals and sort of figure out, all right, yep, I know your whisper is 20 million, but in reality at a 5.5 cap, it's 18 or 17 million. And you just have to hang around the hoop long enough. And then at some point, the seller's going to be like, yep, it's time to go, because I bought it for 10 5 years ago. So they're still going to make money. They're just not making 10 million. They're making 7 million. And so, I think some of these guys are going to step out of the market and sell their deals. And you just have to be active enough, and let brokers know that, hey, you're in the market to buy deals that fit that criteria, and go out there and buy some of these deals.
Some great information from the professor himself. If you haven't watched his YouTube channels, monthly finance updates, it's about 20, 25 minutes. And you can watch that while you're working out or sit on the couch waiting for the commercials to break between the two shows you're watching. Throw that on, watch a little bit of that, get smarter, send that to some of your friends that you think about maybe investing with you, just get them smart about what's going on. So there is an opportunity in the future where there will be that they can throw money into your transaction in the future. So James, again, thanks for that Old Capital Conference. Great show again this year. Looking forward to next year's production. And we certainly do appreciate everybody's business here at Old Capital. James, thanks for your help. We certainly do appreciate that. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.